Well, y'all, this has been a crazy, crazy week for interest rates, for the bond market, for real estate news in general. So we're going to dive in and tackle what has happened this week, what it means for the future, where we might be headed. We're going to try and make sense of it all on today's video. So today is November the 1st, Friday. We waited until Friday today. We always do these calls on the first Friday of the month rather than Thursday, because that is the day that we get the BLS report, the what used to be called the non-farm payroll report. This has been what the Fed has really relied on, even as much or more so than inflationary data, or inflation reporting rather, to drive a direction as to where rates are headed. So we're going to take a look at what the data was this morning. BLS report this morning was a blockbuster to the downside. This should have been very good news for interest rates. It wasn't. We're going to talk about why. The report itself, very weak. We got 12,000 new jobs, 113,000 were expected. Y'all, that expectation is about half what we would normally expect. We'd normally want to see, 230,000 new jobs. So the 113,000 that was projected was already a serious lowball, cutting in half what a typical projection would be, and we got 12,000 jobs. Reason for that, the hurricanes and the Boeing strike and just a number of regional issues that frankly had us expecting a weak number today. Unemployment rate unchanged, 4.1%. Now, that said, the prior report was a weak 4.1. This is a very strong 4.1, almost 4.2. There's actually a 0.94 increase in the unemployment rate based on this number. It's just not reflected when they round it to the nearest tenth as they do in the number. So it was a little weaker than the headline suggests. All the way around, this is frankly everything the bond market should have wanted in this employment report to push the Fed into more aggressive territory for future cuts. Same with personal consumption expenditures. That came out yesterday. This is the Fed's favorite gauge of inflation. It came in at 2.1%, expected to be at 2.3%, so it was better than expected, lower than expected. It's right there at the Fed's target of 2%. So all of this suggests the Fed is going to move at least a quarter at their next meeting on November 7th. If you look at CME Rate Watch tool, or the CMA Fed Watch rather, they do have a 98.5% chance that the Fed will move just a quarter at the next meeting. The CME Fed Watch tool is basically giving us no shot at a half point drop at the next Fed meeting. If the Fed were to shock us with a half point, I think that could send some judders through the marketplace. It might help rates in the short term. It might also cause more concerns about a recession were they to do so. So I don't think anybody expects that that's going to happen. So that leaves us wondering this, y'all. We got basically everything we could have wanted from a reporting standpoint going into the Fed meeting next week. So why are interest rates higher? Let's look at the market. Mortgage News Daily has a 30-year fixed rate conforming loan today at 7.05%. So yes, we were back over 7%. We were at 6.90 1 week ago, 6.20 in that survey 1 month ago. Y'all, just 45 days ago, just 6 weeks ago on 9/16, we were at 6.11, nearly a full point lower than we are today. So what has changed in the last 30 days to push interest rates so significantly higher? Divided government is something that the bond market likes. Divided government, where you have one party in the White House and another party in one or both houses of Congress, is basically the best outcome for the bond market because it makes it difficult to pass spending bills, right? When we spend more money than we take in, we have to issue bonds to make up the difference. In other words, we have to borrow the difference. When you flood the market with a supply of bonds to pay for the government that you didn't tax sufficiently, or that you overspent, that outstripped the taxes that you have coming in would be a better way to say it. You have to borrow the difference. That additional supply of fixed income securities drives the prices down and the yields up, and those yields are our rates. So deficit spending increases interest rates. That is the bottom line, all you need to know for this call. As of 4 weeks or so ago, there was a shift in the market, in the betting markets. If you look at polymarket.com and measure this, you will see that for the last year or so, there has been an expectation that the House would fall into Democrat control. Reminder that Republicans have a narrow majority in the House. I think it's 7 seats. So the projections have been up until about 4 weeks ago when we saw this run up in interest rates, that the White House was likely to go to the Republicans and that the House was likely to stay with the Democrats. Well, that switched about 4 weeks ago. There's now a 53% chance that the House is going to be strongly Republican and only a 47% chance that Democrats would retake control. The bond market doesn't like that. The bond market looks at that as unbridled spending and tax cuts that they think are going to lead to higher deficits. Again, not going to get into the merits of whether that's a factual belief. I very strongly don't agree with it. However, it is what people are trading on. And when people are trading on it, even if you don't agree with the trade, you've got to be aware that that's what's influencing the trade, and it's going to likewise influence your trade in the bond market. So in any event, it's very much a follow me type of thing, the same way as it is in the stock market. Stock market is loving it today. It was up over 500 points earlier when I looked at it. That's also putting pressure in the bond market, and it's why we're seeing bonds selling off a bit today. So I would not be surprised if we don't see a little bit of a higher interest rate posting in Monday's average based on what's happening today. Do I think that this is oversold? Do I think that we've gone too far and that we will see a pullback? I really, really do, y'all. This is not going to be the way of things, particularly if we make our voices known to our elected officials that we're not going to tolerate this unbridled deficit spending going forward. So there is going to be a political plea on this call. It's not just about making your voice known at the ballot box. But once these folks are in office, let's make sure they treat it responsibly by not spending more money than they take in. That is the best possible outcome. I'm not going to hold my breath that that's going to happen because, frankly, neither party seems to know how to constrain their spending, as that's how they reward the people that elected them and funded their campaigns. So that is one of the flaws in our system, y'all. And it's something we're going to have to find a solution to, or it's going to have a bad outcome for us. So in any event, hate to get overly political on this call. Always happy to talk about it, though. So if there's anything that we can help you with, we do mortgages here for a living. We do these calls to provide value and information to you to share with your clients, to earn your referrals. So if you have anyone that I can pre-approve for a mortgage, my contact info on the screen. Would be honored to have your referral. We take very good care of them. As always, stay blessed, stay safe. We will talk to you next week.